want to bring in now BNY Wealth Chief Investment Officer Sinead Colton Grant. Sinead, welcome back to the show. Let's start with this. All the comparisons, and they've been made almost all year long. This is in late July. The big tech bubble, and here, right? I mean, wow, it's sort of ominous. PE ratios are about the same. Normalized PE ratios, peak PE ratios, a little bit higher there, but you can see what I mean. Price to book, just about the same. Price to cash flow. It's felt very ominous from that sort of comparison. What do you tell people when they say, well, how is this different than that last time?
So here's what we always say to our clients. You've got to focus on the fundamentals. Here's what's different. When you look at the largest tech names, the top 8 largest companies in the S&P, their margins are almost double the rest of the index. You're also seeing very healthy free cash flow, so the fundamentals are different. Back in the late 90s, I loved the 90s, but there was a ton of hope, right? PE ratio is another way to think about hope. These companies have the fundamentals to back them up, and that's before we even start talking about the broader economy.
Well, let's talk about that, because you have a bull case, a more macro bull case, resilient growth, consumers healthy, household balance sheets are strong. So a lot of your bull case, I mean, as much as you're talking about these major companies that are unique, right? They've never been this few, 10 companies that have done so much or on a cusp of doing so much. But you like the household situation here as well.
Well, we do. And look, the reason we talk about resilient growth is, remember back in Q2, where a lot of the softer data, the sentiment data was turning down, the big question was, would the hard data start to do the same?
Right.
We have not seen that. A large part is because the consumer is so healthy. Jobs growth is still okay. But most importantly, household balance sheets are very strong. Leverage is at the lowest level in about 5 or 6 years. We've also seen continued wealth increases. Household wealth has increased by over 50 trillion.
Are you concerned that so much of it, though, is tied to the stock market? More household wealth is tied to the stock market than ever before.
Well, yes, but we do want people invested in the stock market, right? That is a participation that is incredibly important. But don't forget about the leverage piece, right? We have a ton of households that have fixed rate mortgages with sub 3% interest rates on them. That's a huge additional wealth effect that we're seeing.
Good. Let's talk about earnings season. Blended earnings, huge, 11%. The consensus, more than double consensus. The beat rate is really high. Now, we know the bar was set a little bit low. Are you happy with guidance? Do you feel like this was an inflection point this last quarter?
It certainly has been. I mean, yes, you're right, expectations were lowered. And when we look at this quarter, that beat rate is incredibly high. When we look out for the rest of the year, we expect that earnings are going to expand by about 11%, and that's what leads to our higher target on the S&P of 6,700. Yeah,
I want to talk about that, because I always say that earnings are the mother's milk of rallies, but it's really margins, right? And margins going to for 14% from 13%. This is really mind-boggling, particularly in the age of tariffs and all this sort of stuff. Do you see margins hanging in there throughout the rest of this year, going into next year?
Yes, we do, and a large part of that is tech. So that 14% is the expectation for 2026. 13.3 is where we are for this year.
Right.
When you look at the margins that some of those large tech names are delivering, they're even higher than this in aggregate. They're sitting at about 14.4% today. So we've got some pretty solid fundamentals.
What are your areas of concern?
Look, we had a strong PPI print this morning.
Right.
Of course, we want to continue to watch that. We expect that the Fed is going to cut twice before the end of the year. We're expecting 25 basis points in September and then another 25 in December.
Were you there before the jobs report?
We actually were.
Okay.
We actually were, because real interest rates are very high. Now, we don't want to see many surprises in inflation. And what's particularly interesting about that PPI report is that it's really the difference between what factory gate prices are and then where companies are selling on to end consumers. So it's a very particular element of pricing, and it's actually heading the opposite direction to what we're seeing in CPI.
It's really amazing. Good stuff. Always glad to have you on.
Thank you,
very, very much. Appreciate it. All right.